The analysis presented in the video is purely personal and does not represent views of any institution I am associated with. Hello everyone, welcome to this new video on the EduYou channel. EduYou is starting with a series of company analysis videos, and today is the first video of that series. Today we will be covering Asian Paints. Asian Paints is India's leading paints and coatings manufacturer. It enjoys 50 plus years of market leadership. It has deeply penetrated the Indian market down to the rural economy. The company is R&D focused and introduces 25 plus color editions every year. They've installed paint dispensing machines with retailers, saving the warehouse costs and pushing Asian Paints' products through retailers. The company manages 70% of its sales on a 3-day payment period, which is the best in the industry. This acts as a solid moat for the company, but the business has been facing challenges due to the rising input costs. Crude oil prices have capped the momentum of the Asian Paints stock in the near future. At present, crude oil forms 55% of the total costs incurred by the company, which is significantly higher than the 35 to 40% proportion in FY19. Despite slowdown in the economy led by tight liquidity conditions and fall in consumption, Asian Paints has delivered strong double-digit volume growth driven by decorative paints segment. The aggressive sales push efforts taken by Asian Paints at dealer level, along with high sales from low-end products such as putty and distemper, have boosted the decorative paints volumes. Stable demand in rural and smaller markets is another contributing factor for volume growth. Companies' efforts to improve the market penetration and to expand to newer markets have paid off in driving demand for decorative paints. The current capacity utilization is expected to gear up with demand gradually as the company looks to lean out its inventory. Asian Paints is expecting a rapid recovery in international operations. It is planned to give a boost to waterproofing products in export business. Its successful entry into new businesses such as putty has driven revenue growth from rural areas. Recovery in new construction projects is also contributing towards volume growth. Now let's quickly run through our presentation. As we've already discussed about the paints industry in our previous video, I would recommend you guys to check that video out to understand the business model of the paints industry in depth. Let's talk specifically about Asian Paints in this video. Asian Paints was founded in 1942 and is currently India's leading paints and coatings manufacturer. It operates in 15 countries and boasts of a robust network of 26 manufacturing facilities. It is the third largest paints company in Asia and the 9th largest globally. The company reported 250 billion rupees of revenue in FY22 and an EBITDA of 5 billion. The bottom line stood at 3.1 billion. The year-on-year growth in the top line was close to 37%, whereas in the bottom line was close to 4%. Some other important numbers with respect to the number of employees, the number of scientists, the number of suppliers, the business influencers is mentioned for you to take note of. I'll take a moment to highlight the fact that Asian Paints is close to a zero debt company and that the company has been delivering strong return on capital employed ratio year on year with the FY22 reported ROCE of 34%. Its market cap grew at a CAGR of 28% in the last 20 years, and the company has maintained a dividend payout ratio of more than 50% consistently, with the current number standing at 59%. Now let's deep dive into some qualitative and quantitative aspects related to Asian Paints. Asian Paints has a market share of close to 58% among organized players. It has a 60% market share in the decorative paints category and a 20% market share in automotive coatings category. The current capacity utilization of close to 63% is expected to increase going forward following the massive capex investment the company has made. The company's SAP-driven supply chain management and a well-entrenched distribution networks helps the company in replenishing dealer stocks within hours in major cities. Also, the company has launched a range of economy products at 18 to 20% lower prices, which have also led to increase in the volume growth. It is also the leading wallpaper manufacturer under the brand Nilaya. Talking about the quantitative aspects of the company, it has delivered consistent growth in the top line and the bottom line over the last decade. The 10-year CAGR stands at 11.7% for the top line and 11.9% for the bottom line, whereas the 10-year average ROE has stood around 29% and the 10-year average return on invested capital has stood at 28%. Crude oil currently accounts for 57% of the total costs, which is on the higher side owing to the rising prices. The EPS growth estimates are expected to exceed 20% in the coming years, which would make the current valuations attractive for the investors. And significant promoter holding of more than 52% shows the faith of the management in the company's current performance as well as instills a belief for a positive future outlook. Now let's drill down into the revenue generated by Asian Paints in FY22. First, we will look at the categories and then we will look at the regions. Looking at the categories, Asian Paints generated revenue in majorly three categories: the decorative paints category, the home improvements category, and the industrial coatings category. Out of the total revenues of 289 billion rupees, Asian Paints generated around 85% of its revenue from the decorative paints category. In the decorative paints category, the company provides interior and exterior wall finishes, metal and wood finishes, and also has introduced new products such as the waterproofing, wall covering, painting tools and implements, including adhesives and sanitizers. The second category, industrial coatings category, contributes around 2.5% to the overall revenue. Through this category, the company caters to the Indian industrial coatings market through a strategic joint venture with PPG Incorporation of USA, which is a global leader in coatings. Through this joint venture, the company offers an entire spectrum of industrial coatings, products such as automotive coatings, refinishes, protective coatings, power coatings, and floor coatings. The third category, which is the home improvements category, also contributes around 2.5% to the overall revenue. Through this category, the company provides two services: kitchen fittings and wardrobe, and bath fittings and sanitary ware, where the customers can create the kitchen space and bath fitting of their choices. And finally, 10% of the company's overall revenues came from international operations. The company operates in 4 regions across Asia, South Pacific, Middle East, and Africa through 7 corporate brands: Asian Paints, Apco Coatings, Taubmans, Cadisco Paints, Causeway Paints, SCIB Paints, and AP Berger. Asian Paints is among the top 3 players in decorative paints category in 12 of the 14 countries it operates outside India. Apart from paints, Asian Paints dealing in metal sanitary ware such as bath, sinks, wash basins, furnitures, fittings, and lightings can drive the bottom line in the coming year. The future earning viability of the company seems lucrative. Let's look at the manufacturing footprint of Asian Paints across the country. The production capacity of the company across decorative paints and industrial paints has been broken down plant-wise. The plants catering to decorative paint segment can manufacture 1.7 million kiloliters of paints per annum, whereas the plants catering to industrial paints category can manufacture 21,200 metric tons of paints every year. The company has also planned capex investments to expand its existing installed capacity. Asian Paints will be investing more than 100 crores in the next 2 to 3 years to expand its installed capacity at its Ankleshwar plant. Once the capex investments will be realized, the return on equity of the company will also increase. Talking about the key financial statistics of the company, together with its yearly evolution, we can see that the revenues of the company have grown at a CAGR of 14% since FY17, whereas the EBITDA and the bottom line have grown at a CAGR of 10%. Gross profit margins have flattened due to the volatile crude prices, margins have taken a dip due to the additional capex investments, and net margins have reduced due to the increasing competition and discounting in especially urban areas. The EPS currently stands at 31.6 rupees per share and has grown at a CAGR of 9% since FY17, whereas the book value per share, which currently stands at rupees 144, has grown at a CAGR of around 13%. Finally, the total debt burden on the company is substantially low, thereby reducing the interest burden on the company and as a result, boosting the PAT margins. Next, let's talk about the shareholding structure in detail and have a look at some of the key financial ratios. The current market cap of Asian Paints is around 3.3 trillion rupees. The promoters hold a cumulative of 52.7% in the company, out of which Gitanjali Trading holds 16.3%. Reliance Industries also holds 4.9% stake in the company. The foreign institutional investors and domestic institutional investors hold 19.5% and 7.2% respectively. And lastly, the retail investors hold 13.1% stake in the company. As mentioned earlier, high promoter and institutional holding indicates positive future growth potential and limited downside risk. Long-term investors will shield the stock from falling rapidly. After analyzing the key ratios over the past 3 years, we see that the receivable days have increased while the payable days and inventory days have decreased. This indicates increasing supplier and retailer bargaining power. A high interest coverage ratio indicates that Asian Paints is well positioned to pay off its interest obligations on its outstanding debt. A very low debt to equity ratio indicates that the company relies on equity financing when it comes to capex investments and expansion projects. The reliance on debt funding is negligible. A strong and consistent return on equity, return on capital employed, and return on invested capital indicates the efficiency in capital utilization and margin creation. Though the scope for further improvement in these numbers exists, as the company is still not running at high levels of capacity utilization. This makes the company a lucrative asset for investors. Increase in valuation multiples shows that Asian Paints is commanding high premium on its business owing to impeccable governance and stable performance irrespective of economic slowdown. Now let's look at the different competitors of Asian Paints and see where they stand as of today. We've selected some key metrics based on which we compare these paint companies, and the grid on the screen depicts least impactful to most impactful performance in FY22. Lightest shade means the least impressive performance, whereas the darkest shade means the best performance in the industry. Just by visually analyzing, we can infer that Asian Paints and AkzoNobel have delivered strong results in FY22 compared to the other competitors. Delving deeper, we see that on the operational front, Asian Paints has outperformed AkzoNobel, but the valuation metrics show that Asian Paints is trading at higher multiples and is a less attractive asset for investors compared to AkzoNobel. But this cannot be looked in isolation to the operational performance. There may be a case that investors prefer Asian Paints because it has delivered the best operational performance, and hence its trading multiples have also seen an upsurge. The company might be demanding higher valuation premiums than AkzoNobel, which may be available at low multiples because the operational performance of the company wasn't as good as that of Asian Paints. So investors are driven more towards Asian Paints than AkzoNobel, and hence the valuations have kept on increasing as more and more inflow of funds have come into the stock. However, it will be foolish to ignore competitors like Berger Paints and Kansai Nerolac, which themselves are pioneers of the paints industry, have delivered consistent performance on the top line and bottom line over the years, and hold a significant amount of market share in the organized sector. Even the new entrants like JSW Paints, Indigo Paints, and Grasim Industries have made heavy capex investments to acquire a significant portion of the Indian paints industry. Moving on to the most important part of the presentation, the broker consensus and forecasts. We have taken a wide range of brokers into our purview for the purpose of conducting a benchmarking exercise. These forecasts have been derived after considering the reports published by the brokers like Citi, UBS, Morgan Stanley, HSBC, JP Morgan, Jefferies, Nomura, Anand Rathi, Credit Suisse, and Ambit. We can see that the revenue CAGR is expected somewhere at 15%, whereas the operating and net profit margin CAGR is expected to be in the range of 20 to 25%, which is almost double of the current posted margins. The rate of deceleration in input costs and acceleration in profit margins would justify the premium valuations at which the company trades. EPS is expected to double by FY25, resulting in the PE ratio of the company reducing to 50x from current levels of 94x. The return on equity is expected to exceed more than 30% by FY25 from the current levels of 23%. Asian Paints has the highest return on equity and volume growth in the industry owing to the robust performance of the home improvement segment. And valuation multiples are expected to reach very attractive levels of investment, which in turn would lure FII inflows into the stock. Distribution expansion in Tier 2, Tier 3, Tier 4 cities, expansion into product adjacencies, focus on economy products, and aggression in home decor are core themes of focus for Asian Paints in the next few years. Finally, moving on to the valuation summary, which is just an extension of the broker forecasts, we've taken 4 scenarios based on multiple estimates and given weightage to each. What's to be noted here is the fact that we've considered past, current, as well as the future estimates of multiples, giving significant weightage to the future estimates, followed by the current numbers, and then finally to the historical trading multiples. We've taken 5-year historical PE average as one scenario, FY22 PE as one, and industry FY22 PE as a third scenario. These together make up 50% of the total target price, whereas the broker estimates of the future PE makes up the rest of the 50% of the target price. This leaves us with the target price of 3245 for FY23 and 3927 for FY24, meaning an upside of 6% and 27% respectively from the prices as on 31st March 2022. What's important to mention here is that we have normalized and standardized the target prices set by the brokers to compute for FY23 and FY24 numbers. Some brokers estimated as of September 23, some brokers estimated as of June 23, some estimated as of June 24. So we had to make sure that we standardize these on a yearly basis for an apples to apples comparison and computation of target prices. One could argue that we could have added the 5-year historical PE average of the industry as one scenario and the average of the broker estimates for the industry as another scenario. And that is absolutely correct. The more scenarios you add, the more refined would be your target price estimates. And hence we definitely advise to add more scenarios here and refine the target prices. Do let us know in the comment section if you have ascertained your own target price. It would be a great follow-up exercise. Now one can say that why didn't we use DCF for the purpose of arriving at the valuation of Asian Paints? We would say that they have a point here, but the reason why we did not use DCF and we used relative valuation method was because of its practical application in the industry. DCF is not used extensively in the industry, whereas relative valuation is. That is because DCF may not work for companies whose business is dependent upon their competitors or on the other industries. It's difficult to quantify these variables into a DCF model, and hence we did not use DCF for the purpose of doing our valuations. We tried to keep it as fair and as true as possible. Let's also look at the M&A scenario within the paints industry since the pandemic hit us. We see that there were 4 transactions that happened in this period in India, and all these transactions were priced at below $50 million. All of these transactions, namely Hella Infra acquiring Shalimar Paints, or Astral Polytechnique acquiring Gem Paints, Saurashtra Cement acquiring Snowsem Paints, and Taikisha acquiring Neromac Clean Rooms Far East. All of these transactions closed at an average sales multiple of 2.3 times, which is too low compared to the current sales multiple Asian Paints is trading at. Hence, we cannot consider these small ticket deals for the purpose of ascertaining the correct or the fair multiple for Asian Paints. And similarly, if we move to the global context, there were 4 prominent deals that happened during this duration. And the 4 notable deals globally were the acquisition of Tikurila by PPG for $1.8 billion, the acquisition of Chromology by Nippon Paint Holdings for $1.3 billion, the acquisition of CVC Specialty Chemicals by Huntsman Corp for $300 million, and Nippon Paint Holdings also acquired JUB for $226 million. And all these transactions happened at an average sales multiple of 2.4x. Asian Paints is trading at 10 times its sales multiple compared to the global peers, which are trading at 3 times. This indicates that the company is trading at higher levels at the moment and is currently overvalued, as it is trading at higher trading multiples, which reduces the scope for enormous upside in future. Hence, the company should be bought at sub 3000 levels for it to be called a safe and a value investment. And the final verdict is that Asian Paints is a pioneer in the Indian paints industry, with a strong performance historically and a potential for future volume growth. Though it's priced high at the moment and is available at expensive multiples, it would definitely be an ideal strategy for long-term investors to buy on dips and accumulate as much as they can at sub 3000 levels. This definitely works for investors who are looking at a CAGR return of 10 to 12% from their equity investments and also want to invest in safe companies. With that, we come to the end of another informative video. In case you like the content, please subscribe to our channel, follow us on Instagram and LinkedIn. If you want to share your views on the topic discussed, please feel free to drop a note below into the comment section. We will continue to bring invigorating and exhilarating content at your fingertips. Till then, goodbye, take care, and happy meaningful content consumption.